Hello, everyone. Welcome to another episode of In Conversation by Advisor Coach. Today in conversation, once again, we have Mr. Gautam Kaul, Senior Fund Manager, Fixed Income with Bandhan Mutual Fund. Gautam, welcome to In Conversation once again.
Thank you. Thank you for inviting me again.
Our pleasure, our pleasure. So गौतम हमारा ये आज का जो पॉडकास्ट है बड़े इंटरेस्टिंग टाइप पे हो रहा है. वॉर हो रही है नहीं हो रही है, वॉर हो रही है नहीं हो रही है, and of course it's completely disrupting the entire economics of the globe
Yes.
and definitely India as well. So I would first of all want to ask you this question, that what are
Hmm.
your thoughts around the inflation, interest rates for India, keeping the entire global happenings across at this point of time?
Uh, so there is the local domestic piece, and then there's the global backdrop. So let me try to separate the two for a minute. Right. Locally, we've been through a period till recent past where inflation has been reasonably under control. As you know, the RBI target is to achieve 4% with a plus minus 2% gap on both sides, and we've largely managed to do that over the last few quarters.
Hmm.
Now, what has changed obviously is that since the war, commodity prices have gone up, and that's has impact on headline inflation. Well, that's primarily on the supply side. The other important factor which has affected rates and financial markets in general in India is the fact that for the last 2 years, our balance of payment has been negative.
Hmm.
This negative balance of payment has put pressure on both our currency and our rates. And that has been a good way of looking at it is that if you think about it, in the last financial year, RBI bought almost 80% of net government supply of
Hmm.
government bonds in terms
Hmm.
of OMOs. And yet interest rates continue to go higher.
Hmm.
Right. So we think the primary reason obviously is the balance of payment challenge. Uh, on the non-SLR curve, there was another significant challenge of credit deposit ratio, where credit
Hmm.
growth for banks was much higher than deposit growth, which led to banks trying to scramble for funds and therefore pressure on the non-SLR side from banks raising CDs.
Hmm.
So on one side, short-end rates went up because of the pressure on non credit deposit ratio, and overall rates in the system as well as currency depreciation happened primarily on account of BOP challenge. In the previous policy concluded previously, RBI kind of, I think, to our mind, addressed both these challenges in a major way by announcing the FCNR deposit scheme and some additional incentives for PSU corporates looking to borrow abroad. Right. So we think this does two things. One, obviously, it brings this what market is expecting anything between 40 to 60, $70 billion of dollar flows into the country. So one, yes, that addresses your BOP challenge in the short term. So for the next year and a half, your BOP should be fairly covered. It also, because it's deposits, helps alleviate pressure on the credit deposit ratio for banks. Right.
True.
So we were going through a challenging phase. Our sense is that on the macro front, the worst on pressure from BOP and CD is probably behind us.
Acha.
That being said, a lot in the world today and lot for our markets today is also governed by what's happening globally.
Hmm. Hmm.
Seen crude go up to 110, come down to 68, 69, now again to 85 as the vagaries of global geopolitics play out. And you cannot ignore those.
Hmm.
Uh, at the same time, we have to recognize these are supply side issues which tend to sort themselves over time. And something like a rate hike does not necessarily have an impact on this. Right? So RBI is taking a very balanced, nuanced view. They're looking not just as headline inflation, which is their main target, but also core inflation to try to strip out what is causing this increase in inflation and whether any action is warranted. The other thing which is happening globally is that a lot of the global capital is flowing towards only one theme, which is the AI build-up.
Hmm. Hmm.
Right? So India has been a loser in on that front, but that's also put pressure on a lot of other sectors. So what's happening is either you have AI and capital is flowing towards you, or you don't have AI and then no one wants to look at you, right? So the other thing we are watching out for is how long this AI theme lasts, and there seems to be evidence that there is some flagging at least in this theme. So if at all this starts to normalize or the AI theme kind of at least pauses for a while and the capital starts to look for other sources, we think that India is reasonably placed to attract those.
Sure.
So
Sure.
challenge from the global macro front on account of AI theme, commodity prices, and finally the US interest rates. So Fed, for the most part, was fairly neutral till a while back, and since then, market has started pricing in potential of Fed rate hikes. So if the US as a reserve currency holder starts to hike rates, then that has pressure on emerging markets, not just India but
Across. Yeah.
across. So
Absolutely.
so our sense and hope is that if this Middle East crisis remains contained and the AI theme kind of starts to cool down a bit, pressure on US Fed to hike rates probably eases off. And if that pricing comes off, then you probably have room for rates to come off globally as well.
Sure.
So that's the basic backdrop we're looking at.
Sure. So when we look at from a BOP aspect, uh, we've had a record remittances in 2025 of almost $138 billion, right?
Hmm,
And of course, we've also had the record outflows of the FIIs at the same point of time.
true,
Okay. And the other, negative, I think probably if I can use that word, is also a lot of Indian corporates. They have been very steadily investing money overseas in for their expansion of the business
true.
rather than in domestically investing while they've
Yeah.
been given a lot of caveat from the taxation perspective as well. So what are your thoughts around that in terms of, you know, do you think this, because see BOP is something आप देखिए FCNR भी डिपॉजिट्स करे या ECB करिए या आपने गोल्ड कर्व करे सिल्वर पे कर्व करे आप कुछ भी करें ऑब्वियसली देयर आर मल्टीपल सो एक ना एक रस्सी छूट जाती है हाथ से. So how do we believe that we can control this, or do you think it's a controllable measure in the times to come?
Look, end of the day, see, historically, our challenge used to be that our capital account was stable. The current account was where there used to be volatility. You know, 2.5% we used to think is fine. When it started,
Mhm.
anytime phases of high growth, it would go to 3.5, 4.5%, and then uh, things would start to go awry, and RBI would have to step in, hike rates, and the cycle continued, right?
Yeah.
So the capital account being the challenge is fairly new for us.
Mm.
Typically, we've been recipients of both FPI and FDI flows for most part over the last 10 years. And frankly, last couple of years when the current account stabilized, we in fact thought that it's structurally very good for Indian rates because the biggest Achilles heel for the last 10 years had been the current account. But meanwhile, what has happened is that we've seen. I mean, I don't think I remember ever seeing such FPI selling in equity on a sustained basis,
Mm.
right? So that's, I mean, ironically, last 2 years, FPIs have been net buyers in debt and then net sellers in equity by almost an equal.
Mm. Mm. Mm.
So
Yep. Yep.
some of that is not in our hands per se. That if let's say uh, as global investors, they are chasing themes where we are not big participants. We'll probably have to just wait it out. Hopefully, we learn. We try to address that shortcoming going forward. So the capital account challenge probably met from there. The FCNR buys us time. Uh, is it a permanent solution? No. Does it buy us enough time to one kind of live through this AI
In fact,
mania?
it's just
Hopefully, yes.
kicking the problem away,
Yes.
basically,
Yes.
on a delayed
We are
timeline.
buying time to try to improve things in a more structural fashion. And I see no reason to believe that that will not happen. Like, if anything, actions by the RBI and government uh, recognize what the challenge is, and there is intent to try to address this issue,
Sure.
right? So we have bought time to address this issue. Hopefully, it comes off. And look, this uh, capital chasing just one very very concentrated theme where maybe some 12 countries companies in the world which are getting so much attention, uh, that to my mind is probably not sustainable.
Absolutely.
So
Absolutely.
some of
Absolutely.
that will also reverse,
Yeah,
right?
true.
So we've kind of swung from in 23, 24, where you know everyone was getting out of Russia, no one wanted to invest in China, and India seemed to be the only destination. And we've kind of probably gone to the other extreme. So
Correct, 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 correct.
pretty soon we should be coming back
And
more.
how well do you believe the effectiveness of the FAR as well as the general restrictions being taken away and the
Mm.
capital gains tax taken away? withholding
Uh,
tax.
yeah, that's a good point which I missed earlier. But yes, so what we saw that immediately after that announcement, there's been a reasonable amount of FPI buying on the fixed income side, and expectation of inclusion in the Bloomberg index is also
Mm.
increased. Uh, from market chatter that we heard last time around, these were one of the major points where investors were unwilling to add India to the Bloomberg index, taxation being a very major part, right?
Absolutely.
So it definitely improves the chances of getting included in the index, which in turn, uh, over time could lead to anything between 15 to $25 billion of additional inflow.
Sure, sure.
And this is stable portfolio flow. This will remain for the most part, right? So I think it helps not just for direct FPI inflow, which has already happened, but also for inclusion in Bloomberg, let's say emerging market index, then eventually the
Yes,
big index, right? So
absolutely.
it's a move in the right direction.
It's a move in the right direction. Wonderful. So, Gautam, when we look at an investor, usually they're all chasing equity, you know, wealth creation. How
Yes.
important do you believe, fixed income products are also, shaping and forming a client's core portfolio?
Well, uh, it's understandable why equity is front and center of any investor's
Mm,
mind. That is where wealth creation happens. That is also the asset class where you can open a laptop, look at the NAV, look at the stock price, and know immediately what is happening, right?
yeah.
So fixed income, on the other hand, is low returns, vague. You don't know what is happening. You don't know whether yields are going up, going down. Acha, 4 basis point, 5 basis points is a big day. So there is no excitement in tracking fixed income. I think what investors kind of miss out on is the importance of fixed income in an asset allocation table.
Hmm, hmm, hmm.
So, look, equity is a long-term compounding journey. That is where it's you best express your equity view, right? Over time, it will create wealth, and you have to let the compounding impact happen over a period of 10, 15, 20 years.
True.
So, to my mind, that the fact that your compounding journey is not interrupted is way more important than the total equity exposure that you have.
Hmm,
Right? So an 80% equity exposure which compounds over 20 years is way better than having a 95% equity exposure, which then you have to bring down whenever you require cash, and then again you have to go up, right? So
hmm.
uh, to our mind, it's sounds very simple, sounds very basic, but asset allocation where you have uncorrelated assets is the key.
Correct.
And that is where fixed income comes in for most portfolios. Uh, it is the anchor, it is the volatility dampener in your
Hmm.
portfolio.
True.
So look at
Absolutely.
fixed income as something which helps in times of need, which will probably something that you can draw down on and add to your equity allocation if there's a equity correction,
Hmm, hmm.
which most importantly helps sustain your equity compounding journey.
Yes.
Right. Also, there is the other aspect of all investments are not equal. Some are for your long-term wealth creation, some are for medium-term targets, some are for very short-term cash deployment, right? So fixed income gives you the option and the opportunity to invest according to your time horizon. So if you're looking to invest for just 1 year, you're probably not looking at equity, right? If you have money that you think you'll use in the next 2 to 3 months, you are better off being in a liquid fund.
Yes.
If you have money which you think you'll probably need in the next 1 year, year and a half, you'll probably want to invest in a money market or a low duration
Hmm,
fund,
hmm, hmm,
right? So the other distinct advantage of fixed income is that it can help you plan your investments according to your investment horizon,
hmm.
and that
Very.
fact tends to get a little underappreciated. But I think the awareness is growing. Uh,
Yeah.
there is ample scope, and now we have first time since March 23 in the last 2 years we've got products which are reasonable tax, which there is no taxation disadvantage, right? So that on the MF side there is the uh, income plus arbitrage fund of fund where long term taxation is 12.5% after 2 years.
Hmm.
On the SIF side, we have the equity hybrid, long short hybrid fund where uh, uh, it is to LTCG after 1 year, right? So uh,
Hmm.
the the pain point that we used to hear from a lot of investors is that, look, taxation just doesn't make it
Hmm.
worthwhile.
Hmm. Hmm.
But I think to a large degree that issue has been addressed as well.
Yeah, very
Uh,
true.
so we think, look, uh, a lot of investment should be, for a regular investor, boring. You decide your asset allocation, you stick to it, you let compounding do its work, and from that perspective, fixed income is a very major part of your asset allocation.
Absolutely. And having said that, on a lighter note, I think over light coffee conversations, markets कितना ऊपर गया on the stock market side is more easier to discuss than our 10-year
Yes.
GSEC का yield कितना ऊपर नीचे गया. It's
True.
also the basic
Absolutely.
understanding on that subject.
It's yes, it's very difficult to. I mean, when if I tell someone I work for a mutual fund and I'm a portfolio manager, their eyes light up. I tell them fixed income, they're like, अच्छा ठीक है.
Okay.
अब इससे क्या बात करेंगे?
और ये आज का नहीं है गौतम, ये मेरे ख्याल से इट्स बीन लाइक दिस फॉर एटलीस्ट 3 decades, since the
Yeah.
time I've been part of this industry. Equity, 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 and fixed income is always a very core part of the portfolio, which usually people.
It's very unfortunate. I mean, so intuitively, I think people do understand it. Like
Yeah,
everyone will have a FD,
correct.
but they'll have money in their saving account,
Yeah, yeah.
but they're not optimizing that part of their portfolio.
Yes, absolutely. So when we look at Bandhan Mutual Fund, you have a lot of
Mhm.
these fixed income products. So what are some of
Yeah.
the, fixed income products which आपको लगता है that should be part of a client's core portfolio? And are there some of the funds also which Bandhan Mutual Fund offers where investor can just park his, immediate need requirements money?
Okay, so the way we try to explain fixed income allocation is that we call it the three lens framework.
Hmm.
So there is the liquidity bucket, the core bucket, and the discretionary duration bucket, or the
Yeah,
satellite bucket, right? So liquidity bucket, as one would expect, is where you can park your short-term funds anywhere from 1 month to 1 year. You will have, even for 1 week for that matter. So there is an overnight fund where you can park your money for even 1 day.
correct.
There is liquid fund where anything from 1 month to 3 month probably makes sense. Then there's the ultra short term money market low duration pack where anything from 6 months to 1 year kind of makes sense. So this is the liquidity bucket. Then you come to the core bucket, which we think is majority of your fixed income allocation. This is the part of your portfolio which is going to be there for a long time, right? So what should be the characteristics of a core bucket? To our mind, your fixed income part of your asset allocation table is the one that provides stability,
Hmm.
which by definition means it has to be curtailed risk. So there has to be curtailed duration risk, there has to be curtailed credit risk. So ideally, it's a high quality portfolio which operates broadly between, let's say, a duration of 1 to 4 or 1 to 5, depending on your risk appetite. A fund like a short term fund or a corporate bond fund or a banking PSU fund is a core portfolio fund where you can park your assets, where you can ride your different rate cycles, where you know that you'll get a reasonable carry. Uh, and during various parts of the cycle, it's not like you'll get crazy volatility. You'll get reasonable volatility, and hopefully over time, you should be able to make a reasonable return. And then there is the satellite pack where you want to express your view on either, let's say, duration, where you think if rates are too high and there is potential mark to market gain, you can allocate to a gilt fund or a dynamic bond fund or a credit fund for that matter, right? But I think it's very important to remember that uh, a majority of your long-term investments probably should be in the core bucket.
Hmm.
You know, in my experience, whenever fixed in, the biggest pain point for fixed income investors in our country has been that when they've confused the core bucket with the satellite bucket.
The usual
Because
case.
yeah, because you're like, अच्छा short term fund, corporate bond fund तो क्या 7.25 7.5 YTM है. Either my credit fund is 9.5% YTM or my gilt fund is given 11% return. So then everything shifts to satellite,
Absolutely.
which you're not supposed to, right? So it's very important to recognize risk adjusted return. Unfortunately, conversations a lot of time just revolve around return. And there's no point talking about return unless you realize what kind of risk you're taking to take
Absolutely.
a return, right? So
Absolutely.
uh, that part, uh, that nuance we still push for because we think that that's one part where most pain for fixed income allocators happens in the long term.
Sure. As a fund manager's delight, if I were to ask this question,
Hmm.
because हमने अक्सर देखा है that when you look at these fixed income funds, a lot of lumpiness comes in because of large clients participating,
Hmm.
right? And of course, it's very difficult, for, your laddering approach and as well as your border crossing assets approach and because आपके ऊपर pressure है, liquidity भी, credit भी, and, high yield भी.
Yes.
So from a fund manager's delight, what do you prefer? More granular participation in the fixed income products, or you're happy with, heavier concentrations as well?
No, so it depends. It depends on the product, depends on the mandate, right? So
Yeah.
there are like you said, there'll be a liquid fund or where the churn, so to speak, or the volatility in inflows and outflows is much higher. Then there are, let's say, a longer duration fund where people typically are not so quick to go in or go out.
Mm,
And so that is one thing that defines a lot of what we do.
mm,
Uh, Other than that, I think the way we approach it is that we first have a macro view. Once we know, or once we think where we know where we are in the rate cycle and where we think we are headed, is when then we look at the different curves, the SLR curve, the non-SLR curve, and try to find relative value. Where do we think that there is most relative value?
sure,
And then you try
sure.
to spot those points on the curve. Most important for us is to keep assets which are fairly liquid.
Mm,
Because
mm,
there's control over. So unlike a bank who can give a loan and then take FDs against that,
mm,
borrow against it, we can't.
mm.
So liquidity of an asset is very important.
Extremely important. Extremely
So the
important.
way we approach it is that I want the most liquid asset. If I am buying something which is slightly less liquid, am I getting compensated enough for that lack
Mm,
of liquidity?
mm.
If I am, then yes, I'll be willing to look at it. If not, then I probably want to avoid it.
Sure. If I were to ask you for a HNI or a individual investor, let me not
Hmm.
use HNI retail as individual investor, uh, looking to invest, let's say, for about three to upwards of that,
Hmm.
what fixed income fund would you kind of suggest from the baskets of funds? Because I do understand Bandhan has multiple great fixed income products as well.
So look, there are two ways of looking at it. One is I would say stick to that core bucket. Most
Mm,
of it probably goes to your short-term corporate bond fund, medium-term, or
mm,
banking PSU funds. These are the
mm.
core buckets. If, however, you are the type who says, "Look, I don't want to take any call on the rate cycle. I'm happy with the fund manager's view. I've seen his
Mm.
track record, and I would be happy to go with whatever decision he's taking." Then a dynamic bond fund is also a fantastic
Yes,
where
correct.
where you the portfolio manager has the flexibility to go from, let's say, a maturity of 1 year to a maturity of 30 years.
Yes,
Right? So there, of course, there's your investment horizon has to be longer. Because you have to wait for the view to play out, for the cycles to play out. But it can be very rewarding as well. Uh, the other aspect which has come in since March 23 is the taxation angle.
mm,
Right. So if you want to look at what your post-tax experience is going to be,
mm,
then you have to look at either the income plus arbitrage FOF category
mm.
or the SIF, which offers a very, I think, the best post-tax experience that you can potentially get in the current environment.
Sure. When we look at fixed income products, we have the credit, liquidity, and the interest rate risk,
Hmm.
etc. And so, how does Bandhan Mutual Fund manage these three risks? And the extension of the question is कि ये जो potential risk class model
Hmm.
introduced, right? How relevant is it not only for an investor to understand, but also for a fund manager to understand that where his fund is actually shaping up?
So I'm glad you brought up the PRC, potential risk class matrix. It's a favorite thing. So look, I think it's a very powerful tool. I'll talk about it first because I think it's still very underappreciated. Uh, most times what happens is, no, you have indicators or tools which provide you good information, but they're very complex. Or things are simplified to a degree, which is so where in order to explain to an investor or an allocator the risk, sometimes it's simplified below the actual complexity.
Yeah.
Very rarely do you come up with a tool or a solution which is simple yet powerful, right? So for people who don't know, the PRC or potential risk class matrix is a 3 by 3 matrix, where all fixed income funds in the Indian mutual fund industry have to choose the maximum credit risk they can take and the maximum duration risk they can take, right? And that those two are combined into one number, and that in one shot tells an investor or tells a distributor what is the maximum potential credit and duration risk this portfolio is allowed to take, right? So it's guardrails, and it's guardrails which is monitored on a daily basis, which is part of a fundamental attribute which you cannot just change on a whim. So I think it's introduced uh, discipline for the portfolio managers. But it's also shifted responsibility a lot more to distributors and investors,
Very true. Very good point.
right? So now you can't come back and say, look, I invested in a portfolio that time it was AAA, but now it's 50% AA.
Hmm.
If the portfolio PRC is B, he's telling you upfront that I can go to AA, right? So then it's for you to decide whether you are okay with the portfolio potentially going to AA or not.
Absolutely correct. Absolutely correct.
So power has come to you, but so has the responsibility.
Yes. Yes. Absolutely.
So I think that tool is still relatively underappreciated. In our case, our philosophy is very clear. We think that,
Hmm.
like I said earlier, the fixed income part for your portfolio is the stable part. It is the low volatility part. It is the part of your portfolio that will do well when the equity part is underperforming or other parts of your portfolio are underperforming. So by nature, there has to be relatively low correlation to equity, right? And for that, you have to have the highest quality assets. So if let's say you have a credit of a corporate which is relatively lower rated,
Hmm.
then when the economy is doing well, the corporate is doing well, it's a good time to have that credit, right? Because the corporate will have cash flows, their ability to service debt will be better. However, in times of downturn, the ability to service debt reduces. So for the marginal borrower, which is lower rated, their debt in one sense is pro-cyclical. When the economy does well, their debt will do well. And when the economy does not do well, their ability to service that credit reduces or service that debt reduces, right? So it kind of is more correlated to equity than you would like in a diversified portfolio. So our philosophy has been to stick to the highest quality, most liquid part of the curve as far as possible. And that is why in a lot of these categories, you'll find we are only one or two of the PRC A funds.
Hmm.
Means that our weighted average rating of our portfolio has to be AAA at all times.
Yes. Yes. Absolutely.
But what that does do is it helps keep the portfolios very liquid. And when we identify turns in the curve or when we identify opportunities of shifting from one part of the curve to the other, it's much easier to execute it with a liquid portfolio than a relatively liquid one.
Absolutely.
So
Absolutely.
typically what you'll see is our YTMs are lower than most other funds in our peers. That is because the portfolio credit quality is generally way better than peers.
Yeah. Yeah.
And which brings me back to that point about not just looking at return or YTM, but risk adjusted return,
Hmm. Hmm.
right? So the way we approach it is that if I'm getting 50 bips extra for an asset, right, it's not out of the goodness of the heart of the borrower.
Tell me honestly, how many people understand that?
That is true. So
Absolutely.
you have to ask the question, why am I getting this 50 basis point extra? And it could very well be that liquidity is slightly less, or credit quality is not as super prime as, or it could be in a industry which is a very heavy borrower. So typically, let's say an NBFC will pay much higher than a PSU AAA will, right? So as long as you know that yes, it's a fair compensation, you should be happy to take it. There are often enough times where uh, we think that you are not getting adequately compensated, in which case we are happy to let that go.
Absolutely.
And so that's the basic philosophy, is to get uh, compensated for any risk you're taking. Otherwise, do not take that risk.
Absolutely. And I think regulator also has done an incredible, job in terms of potential risk class matrix, for example.
Absolutely.
It just gives you in one spread as to where the fund is, and it has educated the investor as well as the advisor distributor key. Look, there it is. Now you decide what you
Ah,
want to do. Correct?
I think it's
So,
wonderful, right? I mean, you're giving the power to the advisor or the
absolutely.
investor.
Plus the entire, subject of segregated portfolios, which
Hmm.
many instances we did see, because it is very important that a particular scheme should behave as per its fundamentals.
Absolutely.
Correct? You cannot expect one fund which is supposed to be a parking fund behaving like a strong
Yes.
duration fund, because
Yes.
there are ways and means to do it,
Yes.
right? Within your approach on the macro duration. But the idea is that, be true to the fundamental. And that is something which, PRC really defines very clearly. कि आप
Yes.
कहाँ पे खड़े exactly. It's
Yeah.
very, very
And
important.
look, it boils down to the same point, right? Anytime you're choosing a fund and you are naturally the inclination is to go for higher return.
Absolutely.
How much higher and what is the risk you're taking for it?
Yeah, but the cycle does turn.
Yeah. So you have to be ready for that. I mean, so
Absolutely.
I think
Absolutely.
awareness is the key.
Awareness. So that would have been my next question. So what do you believe, being a fixed income career professional
Hmm.
person, that we should do as an industry,
Hmm.
to increase the awareness on the fixed income side and fixed income products? Because we really need that asset class to come into a client's portfolio as a core asset
Yeah.
allocation process.
I think what I've noticed is that uh, for HNIs or people who have generated enough wealth,
Hmm.
there is an automatic allocation to fixed income. They realize that
Hmm.
I want some wealth preservation. I don't want to generate wealth. So there
Hmm.
is that
Hmm.
inclination towards. But for people who are starting on their investment journey or people who are still trying to build wealth, the temptation is to take as much risk as possible with the assumption that eventually it will
Hmm.
lead to return, right? So
Hmm.
uh, I think it's to try to simplify is the best thing, right? Which is not to say that you should not understand it, uh, but get your basics right, get the asset allocation right, understand the risk you're taking. Too much of the conversation in financial markets is around return and not around risk. Whereas the only variable that you can actually control is risk. You don't have any control over the return, right? So if the conversation is around what kind of risk you are happy to take with different parts of your portfolio, and that is the approach you take, then the returns become a derivative of whatever risk you've taken, right? So it's not very intuitive, but if the approach becomes that I have these different parts of my portfolio, this is my investment horizon for these different parts of my portfolio, and this is the maximum risk I'm willing to take, or this is the kind of risk I want to take in these parts of my portfolio, and you regulate the risk, the return is an outcome,
Absolutely.
right?
Absolutely.
And you are more in control. Whereas you can chase past performance, you can chase themes, you can go to mid cap, large cap, small cap, duration, whatever. And if you're chasing returns, it's always a fool's errand. So I think, risk, understanding and appreciating risk and discipline.
Sure. So, as a closing message, what you would like to, send out to all the distributors, advisors, investors listening to this podcast about fixed income products as part of their, suggestion, recommendation, and allocation.
I, I, it'll end up sounding like repeating myself once more, but understand what all these allocations are doing for your overall portfolio, right? Don't try to chase the maximum return in all your buckets. Understand the risk in all your buckets. Understand what this allocation does for your portfolio. In our view, fixed income is the anchor of your portfolio. It's the volatility suppressor on your portfolio. Use it like that. Uh, it is also, like I said earlier, to help you continue your compounding journey of your equity allocation. So times of drawdown, you don't need to take out assets from your equity allocation. You use the fixed income allocation, right? So,
True.
uh, and don't go in fixed income. Look, you look at most funds, right? The return differential between the top and the last performing in most categories is 0.5%, right? So for all the extra YTM chasing that you are doing,
And the effort.
and so I would say just control the risk and the rest will take care of itself.
Absolutely. Absolutely. I would say you're bang on to the point, and I just hope all the people listening to this podcast do understand that, because it's very, very important, because, a 3 basis to a 50 basis changes the world
Yes,
in the performance, but may not for you
absolutely.
as an investor.
Absolutely.
Thank you, Gautam. So, well, for our viewers, this is Mr. Gautam Kaul, Senior Fund Manager, Fixed Income with Bandhan Mutual Fund, taking us through what he believes all about the fixed income world and the interest rates and what the global happening. And of course, Bandhan Mutual Fund does offer a handful of wonderful fixed income products, like Gautam mentioned. So, Gautam, thank you very much for joining in today and taking out time
Pleasure.
during market
Pleasure.
hours. Thank you very, very much for that.
Thank
And
you. Thank you for inviting me again.
my pleasure and our pleasure. And for our viewers, please, hit that like and subscription button for more such wonderful podcasts coming from Advisor Coach. Thank you, Gautam. Thank you very much.